Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So I was talking to a friend of mine, we're just talking about stock markets and so on, and he is a sort of an index investor. So he likes to buy ETFs, index and so on, and he hasn't actually gone too much into the individual stocks and so on. So he's now starting thinking about it. He's got his ISA account, we were talking about it, and he was saying, just give me some foundational stocks that I can buy, that I don't want to buy just like for the basically income. I just want a price appreciation. I want a good companies that will be foundational stocks that can be the S&P 500. Like, give me some ideas and I'll do my research. He's a well educated person, so he was talking about starting his own kind of portfolio. And then we will start doing like a got our laptops and just checking some companies and talking about this. And then that's basically how this basically video was born. And some of the companies we're going to talk about today, plus others that I couldn't include in here because it's too long, are where basically the stocks that we talked about. So what I'm going to do is I'm going to talk to you guys about 5 companies today, share with you guys 5 companies that we talked about that beat at the S&P 500. And also what he was looking for is companies that have a wide moat, companies that have for example, are very profitable and diversified within as well. So all the companies that we're going to talk about today have basically related to technologies, but within that they also are diversified. So let's get started. But before we do that, as always, please, if you can join us Patreon account, it really makes a massive help, makes a difference to me. And so yeah, if you can join us, that will be absolutely amazing. Worst case scenario, just like the video, subscribe to the channel, share it with your family and friends and so on. I don't want to make the video any longer than it needs to be, so let's talk about these 5 companies. Like I said, every single one of these companies has a wide moat, and every single company is profitable, is also diversified. Some of them have been around for quite some time. Some pay dividends, some don't. So exactly what we normally we are looking for what we normally look for in terms of basically a dividend side of things, in terms of profitability, how effective the management is, the free cash flow of the companies, and then EP expected growth for the next few years. And then we will look at a Morningstar valuation, not seeking alpha. I always use Morningstar valuation because I find it has some sort of a margin of safety. Basically, if you look at, for example, Seeking Alpha, they take a sample from all the Wall Street analysts that saying is going to go to the moon, is going to go up this much, and then they kind of give you an average. Whereas these guys are using discounted cash flow models to actually come up with a price intrinsic value for the business, rather than just telling you exactly what's going to happen next month. Okay, it tells you basically the intrinsic value of the business, which is quite nice, which is basically what we wanted anyway. Okay, so that is the reason why I use this. Let's talk about the first company, and that is TSM. So when we were talking about it, I just said to him, do you know what? It will be better to own some of the really good companies out there that we know that are going to be there for a long time. And TSMC as well as ASML are probably one of the companies that are going to stay there, potentially because of AI, because of quantum computing, or whatever the case might be, whatever comes next in terms of technology to change the world, they're going to need some of these companies. Okay, and as you can see here, we got a market cap of 840. It has a wide moat. It has a dividends as well, which is quite nice. Profitable, very 41% in terms of profit margin, return on equity, return on invested capital, amazing. Free cash flow over $30 billion. EPS growth expected to be about 32. Revenue about 40%. Morningstar saying it's about 36% upside from where we are. I'm potentially looking at this one to actually buy it in the invest account. You can't buy it basically in ISA accounts, but you can buy the investor account, which I actually used to own. I don't know if you remember, if you've been with me for quite some time. I used to have it for a very, very long time. I think it's about 4 years ago when I started the portfolio. I think it was in the investor account. But yeah, so $262 per share is where they think the price should be for that one. And now if we look at the fast graph, for example, one of the reasons I've included this is because the company has actually been in this the S&P 500 over the last basically 1 year, 3 years, 5 years. So you basically check it doesn't matter. They beat the S&P 500, which is quite nice to see. The next company we're going to look at today is Mastercard. Mastercard is another company. So I said to him, just check your pocket. You've got companies like, what's in your wallet right now? Probably a Mastercard that you use all the time. How many people out there use this company on daily basis. And again, remember, this company does not deal with the riba side of things. They are a transaction based company, so technology based company. They just facilitate for those transactions, make sure it goes from A to B without any problems and so on. They don't basically deal with the base. They don't even, they don't care about what is in it. They just can make sure that it goes from A to B and everyone gets paid securely and so on. So 525 billion market cap. It has a wide mode, $585 per share right now. Dividend yield is very small, but the dividend growth is absolutely beautiful, and $3 is what you get for every share of this company. It's very, very safe. Okay, profit margin, return on equity, return on invested capital. There are not that many companies that can do this, okay, which is one of the reasons we've included here. Free cash flow over $14 billion. Now that is a money they can use to buy back their own shares, to pay off dividends, to pay off any debt, to acquire other businesses, for example. They can do so much with that money, okay, which is really good. EPS expected to grow about 9%, so it's not bad at all. It's not a high growth company, but it is good. Okay, high single digits. Revenue, we're looking about 13%, which is basically very nice. And right now it seems overvalued, so about 15%. So I wouldn't basically touch it right now. So that's another thing we talked about when we talked about valuation side of this for this company. Again, when it comes to being the S&P 500, so the company we're looking at, Mastercard, if you scroll down, you can see 1 year, 3 years. Basically, it doesn't matter what you look at. It has beaten the S&P 500 over the last 20 years per annum, which is absolutely amazing to see. The next one that we're looking at today is CRM, or Salesforce. Started paying a small dividend very recently. Profitability is really good. Return on equity is getting better. Free cash flow is actually gone better, $12 billion, over $12 billion. EPS is expected to grow about 11%. Revenues about 9%. The company reported earnings recently, so I've looked at it very briefly, but I haven't gone to, basically I just need to listen to the earnings call, inshallah, in the next couple of days. Morningstar valuation is basically saying it's about 19% upside from where we are. $315 per share is where they think price should be. Right now it's 265. Hence, potentially I would do own quite a bit of this company, so I'm planning to look into it, inshallah, whether I'm going to add more to it or leave it alone. Now, looking at fast graph, we can see here when it comes to basically beating the S&P 500, basically the 5 years is actually not that basically, well, it's the S&P 500 won that race, but all the other years the company has done absolutely amazing, which is really nice to see. And then the next one, I want to make sure the video is not too long. Okay, the next one is Arista Networks, again another network company. So I'm going to talk about each one of these companies in a bit, but the networking company, this is probably the company that's going to get rid of Cisco at some point. They have a similar sort of a product, but I've realized even our company, they're opting for more Arista Networks basically devices than actually Cisco. So we'll see what happens with that. They also have a wide mode as well. They don't pay any dividends. Profit margin, return on equity, return on invested capital is really, really good. Free cash flow over closer to $4 billion. EPS expected to grow about 13%. Revenue is about 20%. It's about 5% upside, downside from where we are right now. So it's overvalued basically about 5% according to Morningstar. But yeah, it's a really great company overall. But if you get a massive drop in the next few months, potentially it will become undervalued again. Now looking at fast graph, as you scroll down, you can see here very close this year. Okay, so for the 1 year, for the 3 years, there's no competition there. When it comes to the 5 years, is the same. 10 years is the same. 15 years is the same. 20 basically years is exactly the same. So company has done absolutely amazing over the last whatever years. I don't even think this company actually existed 20 years ago. It has started, I can't remember exactly, but I don't think it is, because as you can see here, you've got about up to 13 years, so probably about 13-14 years. But it doesn't matter. The company has been basically beaten the S&P 500, which is nice to see. And the final company today is Forina. This is a basically cybersecurity company. It has a wide mode as well. No dividends right now. Profit margin, return on equity, return on invested capital, probably one of the best in here, let alone anywhere else. Free cash flow over $2 billion. They're expecting the earnings to grow about 5%, which is not great. Revenue about 13%, basic 6% upside from where we are. $108 per share is where they think the price should be. I'm finally looking at fast graph, as you can see here. If we scroll down, you can see they have been beating the S&P 500 every single year, basically 1 year, 3 years, 5 years, 10 years, and all the way to 20 years, which is absolutely amazing to see. Now, so what we did was we talked about these companies. Let me show you Sharia compliance side of things before I move on to that final part, and you can pause the video and have a look at that as well. So when we were talking about this, we were talking about companies basically that has a white mode and excellent free cash flow as well as profitable. And we said, okay, so this is semiconductor company, this is basically transactions and so on. So again, technology company, this is the cloud side of things, AI side of things. Okay, when it comes to customer relationships management side of things, this one is a networking, this is basically security. So although they're technology companies, they are very well diversified. So I said to him, like, I'm not giving him basically financial advice, because he's actually way more than knowledgeable than I am. But when we talked about, we said this is very well diversified, and if you own these companies, of course some of them, if the overall technology sector goes down, it's going to go down a lot. But you don't need to own every single one of them. You can own 2 or 3 of these companies and then build all the other companies around it, which is basically what I have been doing. If you think about it, I've got companies like Broadcom, for example, and I also have companies like Mastercard. I've got ASML, and for me, Nvidia. So I'm more of a, to be fair, I'm more of a semiconductor company. Look at this, and basically these 2 are semiconductors. This one is a semiconductor. So I've probably got more semis than actually anything else. It's not as diversified as this one here. So potentially something I might need to look at in the long run. But overall, they are still diversified. Okay, so and this is something we talked about. And again, look at this, high quality businesses is still not basically too expensive. Okay, done absolutely amazing job over the whatever years. They have all white mode, which means they can basically still grow their basically top line, bottom lines, because there's not much of a competition out there. And if there is a competition, they basically are the go-to companies basically within their sectors and so on. Okay, so we'll see what happens. Anyway, overall the markets does what it does, but the most important thing is when you're building your own portfolios, you need to have a high quality businesses like these ones here. I'm not saying go away and buy them right now, but of course you do your own research. The ones that I own is basically this one here, Mastercard, CRM, and Forina. I do own them, all 3 of them, in different portfolios. But yeah, that's what I want to share with you guys. I hope you enjoyed the content. If you are, please don't forget to join us the Patreon account. It might just cost you less than, I don't know, less than £5, but you get a lot out of it, inshallah. Have a wonderful day. Assalamu Alaikum.